It's a great honor and pleasure to introduce someone who's known to every one of you. It's Paul Volcker, former chairman of the U.S. Federal Reserve System, a good friend, and I should say that these days Paul is dedicating much of his time to the Volcker Alliance, which he launched in 2013 to address the challenge of effective execution of public policies and to help rebuild public trust in government. This has always been near and dear to Paul's heart, as so many of you in the audience know are his friends, and certainly I've never come across in all my travels around the world a greater public servant than Paul Volcker. Paul, the audience is yours, and everyone's waiting to hear your thoughts on what's going on in regulation and elsewhere around the world.
Fulsome remarks, Bill. Friends of the Bretton Woods Committee, you know, I feel a certain affinity to this organization. I was there when it was born, and I am well aware that its origin in 1983 grew out of a deep-seated concern that the international financial system was under great strain. It's a common phenomenon these days. But that strain was considered to have potentially adverse consequences for international cooperation. The role of the International Monetary Fund, which of course had been established at Bretton Woods in 1944 as the guardian of a regime of fixed exchange rates, had come into question in a world of disorderly exchange rates. Meanwhile, its sister institution, the World Bank, found itself on the sidelines. Back in the early 1980s, there were massive flows of funds to the less developed world at their own volition, and it all suddenly came to an end, setting off the Latin American debt crisis of the early 1980s. Now, in the midst of those strains, the founders of the committee recognized that active American support of the Bretton Woods institutions and more broadly of international financial cooperation would be critical in maintaining a stable and open financial system in support of growth and prosperity. But here we are, more than a generation later. Major exchange rates are not fixed. Extreme fluctuations have at times continued to lead to distortions in trade and inflame political relationships. Recurrent efforts within and outside the fund to find greater stability have lacked support. And today, it's as much the United States that needs infrastructure investment as it is the old bank clients who are now fully emerged or emerging, and for the most part have their own recourse to market borrowing. Now, for all of that, what remains, of course, is the basic role of the Bretton Woods Committee, to force an understanding within the United States of the need for international cooperation, whether by means of the fund or the bank or other sister organizations. After all, Bretton Woods is not a particular institution. It is an ideal. It is a symbol of never-ending need for sovereign nations to work together to support open markets in goods and services, and these days in finance, all in the interest of stable, growing, and peaceful world economy. Now, in some ways, progress toward that end seemed easier, but I can tell you, of course, it was not really easy when the United States economy, its dollar, its basic policy and political orientation were dominant. We can talk together about how the world has changed, the difficulty of reaching common approaches after I finish these remarks. But I do want to take a few minutes to speak about one area in which the need for big changes, national and international, was thrust upon us by the great financial crisis and its threat to the world economy. My obvious point is that the depth and breadth of the crisis demanded a coordinated response. And by and large, I think the international response, for all its fits and starts, has been reasonably successful. With the newly reformed and elevated G20 providing political impetus and cover, substantial progress has been made, particularly in the Basel environment, to strengthen bank capital and liquidity requirements. Common ground among nations hosting the main financial markets is being found in addressing the complicated challenge of orderly resolution of failing banks operating across national boundaries. Efforts to recognize and reduce the risks of derivatives are receiving some attention, as is the need to encourage coordinated oversight of the so-called shadow banking system. But for all of that discussion, all of that progress, I have a new concern. Perhaps it's inevitable that after a few years of recovery, rising profits, and the seeming restoration of financial stability, the presumed unshakable commitment to sustaining reform seems to be waning. That may be most evident in the United States, but it's true elsewhere as well. A few years of greater stability should not mislead us. Relaxation of key reforms and the temptation to retreat inward into idiosyncratic domestic approaches needs to be resisted. Fragmented approaches toward what are inherently international markets and inherently international financial institutions would have costs. Would have costs in terms of fair competition, global market efficiency, and the ability to reach a concerted approach in the event of the inevitable serious future crisis. For instance, diverging regulatory approaches might lead to ring-fencing banking operations within national borders. Coordination of emergency responses to orderly resolution of global firms would then be gravely impaired. Here in the United States, the Dodd-Frank legislation laid out at great length a basically constructive approach for financial reform, regulation, and supervision. Now, there's no doubt that the law and even more the subsequent regulations are highly detailed. After years of experience, a review of some of its provisions and practical effects is certainly appropriate. But let me say at the outset that claims that Dodd-Frank and other regulatory approaches have somehow gravely damaged the effective functioning of American financial markets, our commercial banking system, and prospects for economic growth simply do not comport with the mass of evidence before us. Here we are in 2017 with a nearly fully employed economy, close to stable prices. Bank profits reported in the press daily are at new records. The return on banking assets again includes the old benchmark of 1%. Loans at both large and small banks are at new highs, double the pre-crisis years. In fact, loan growth has been so rapid that it now exceeds growth in nominal GDP. Long continued growth, I would remind you, in debt faster than in GDP will inevitably spell trouble if long sustained. Today, non-performing loans are down close to the early 2000s, and prodded by the national and international regulators, capital ratios are higher than in many years. It's also true that the returns on bank capital have not reached their pre-crisis exuberance. But that's hardly surprising in an area of interest rates approaching zero. That relatively happy story doesn't negate the simple fact that review of some of the specifics of Dodd-Frank may be in order. For instance, reasonable questions have been pressed about the extent of the regulatory burden on community banks, institutions that play a critically important role in serving the needs of small businesses. It is also true that the basic role of community banks channeling local core deposits into small business lending is not systemically risky. And individually, true community banks are not likely to be too big to fail. So recognition of those facts suggests relief could well be appropriate from the burdens and complexity of international capital standards, from the full panoply of stress testing, and from the frequency of full-scale examinations and the complexity of call reports, all gauge necessary for more complicated, large and international institutions. Now that's easy to say, but the challenge, of course, is to define just what institutions are in fact truly community banks. It's not just a question of size. Trading activity and certainly speculative financial positions are not and should not, in my mind, be characteristic of a true community bank. Indeed, we should be aware of aggressive risk-taking in the form of community bank clothing. Recently, I noticed discussion has been renewed about the possibility of turning the regulatory approach back to prohibiting investment banking activity by all commercial banks. That is, to restore Glass-Steagall. That would raise much larger issues than a simple tweaking of Dodd-Frank or of the so-called Volcker rule. The questions go beyond the reorganization of huge institutions at the heart of the modern financial system. I would point out that inconsistency with international practice would itself be a problem. Restoration of Glass-Steagall in any event must not enable large investment banks to free themselves from regulation and supervision appropriate for systemically important financial institutions. We must also be mindful that the combination of large banks and trading activities does give rise to chronic problems of conflicts of interest and the potential degradation of customer relationships. As you know, back in 2009, when Congress was debating the proper response to the financial crisis, I made a seemingly modest and sensible suggestion to help ameliorate that problem. Banking institutions protected by the federal safety net should be prohibited from taking proprietary positions, prohibited from speculation. Specifically, they could maintain trading operations responding to customer initiatives, but they should not deliberately speculate in markets for private securities or, within narrow limits, sponsor hedge or equity funds, the epitome of proprietary businesses. I was naive enough to believe the basic concept and intent could be readily set out in the reform legislation with appropriate supervisory oversight. And I have to tell you, after much debate, the prohibition took up less than 10 pages in Dodd-Frank. But of course, agency interpretation of those 10 pages became a grist for the lobbying mills to populate the Washington swamp. They pressure the regulators as well as congressional and administrative officials. Now, questions have been raised, some reasonable, some not, about clarifying the practical application of the concept. In the process, the regulators themselves, each with different priorities and financial industry relationships, haggled endlessly over the precise interpretation and enforcement of the legislative intent. They moved quickly. It only took 5 years. But helped by aggressive urging of the Secretary of the Treasury, the 5 directly affected regulatory agencies, the OCC, the SEC, the CFTC, the FDIC, and the Fed, finally came to common and certainly detailed language on a final rule. Meanwhile, my sense is that the large banks with sizable trading operations have been adjusting to the basic requirements. Proprietary trading units have been closed. Equity and hedge funds have been sold or spun out. Traders are subject to appropriate constraints, and there's also been a clear tendency for the most aggressive traders to leave the government-protected banking section for relatively unregulated hedge funds or other firms that are free to trade, to speculate to their heart's content, and to fail outside the official safety net. Importantly, statistical evidence strongly supports the view that the market functioning with respect to bid-ask pricing, market stability, and so-called liquidity has not been appreciably changed from pre-crisis performance. Data recently released by the Federal Reserve support those points directly. Put simply, customers can be and are today well served by today's trading markets. Two other issues, seemingly less pressing but of particular importance, definitely need attention. First, Dodd-Frank sets out a new approach for dealing with the imminent failure of a large, complex financial institution. The procedures are designed to deal with the awkward and politically sensitive dilemma between bailing out failing big banks with taxpayer money on the one hand and refusing such assistance on the other hand, with the clear prospect of precipitating contagious runs and huge damage to the economy. The point of the proposed Dodd-Frank reforms is to deal with that dilemma. It would provide an approach for dealing with an imminent failure of a systemically large bank by means of a new resolution framework and an orderly liquidation authority known as OLA. That framework explicitly sets out procedures by which the failing bank could, in fact, be reorganized and liquidated without precipitating infectious runs and a freezing of interrelated markets. Under the experienced auspices of the FDIC, managements would be removed. Viable operations could be sold. Stockholders and unsecured creditors would lose. In effect, there would be an orderly liquidation of the failed firm with breakup and sale of the viable operational assets. In the process, some temporary advance of public funds to maintain continuity of operations may indeed be required, but those funds would be secured by a prior claim on all the institutional assets and, if necessary, by fees imposed upon all systemic financial institutions. I submit to you that under the provisions of OLA, the failing institution will, by any reasonable definition of the word, will have in fact failed. There is no taxpayer bailout. Rather, it is the absence of a resolution framework that might inexorably lead to some future government to feel the need to rescue big failing financial institutions, just as happened in 2008 and 2009. Apparently, that is not fully recognized or felt to be credible by some in the Congress. But what needs to be understood is that the existing approach has been developed in concert with other leading international regulatory authorities. This is an area where a common methodology is critically important. After all, the banking institutions potentially involved invariably are themselves international in scope. Now finally, Dodd-Frank and the whole reorganization effort has left largely untouched the regulatory and supervisory arrangements in the United States. The historically fractured regulatory framework is riddled with gaping holes and overlaps. The inconsistencies in approaches among the half dozen or more regulatory agencies stand as an enormous obstacle to achieving consistent and effective oversight of the financial system. It was this disjointed regulatory structure, among other public and private sector failings, that lulled regulators into a false sense of security before the crisis, and it deprived them of the understanding and the tools necessary to address expeditiously threats to systemic stability. Now, a wholesale redesign of the regulatory framework was simply not possible in the aftermath of the crisis. There were simply too many other competing legislative priorities. Instead, to facilitate agency coordination and help close regulatory gaps, Congress established the Financial Stability Oversight Council, the famous or infamous FSOC, a super council of regulatory agencies that's chaired by the Secretary of the Treasury with a specific mandate to identify and address the threats to financial stability. While aimed at dealing with a very real concern of agency coordination and cooperation, the FSOC has itself become a matter of some controversy. It's made real progress in data gathering and analysis in other respects, but we need to recognize the FSOC is insufficient as a vehicle to overcome the serious fundamental flaws in the regulatory architecture. It cannot force competing agencies to take coordinated action. It cannot itself be a focus for cooperation with our international counterparts on systemic issues. It's simply not adequately equipped for the challenge of fairly and effectively actually supervising financial markets with the complexity, sophistication, and size characteristic of the 21st century. I know of no matter of financial regulation in which there is so much common concern and common agreement among those regulated and those doing the regulation, and those who over the years have participated in reform efforts, of which there have been a number concerned about the fragmented structure of regulatory agencies. Despite all that complaining and agreement upon the difficulties, there's enormous resistance to change. Turf is vigorously defended. Particular interests find advantages in institutional diversity. Now, I well understand that reform is a difficult political and administrative undertaking. There have been efforts, some 50 efforts we counted over the years since World War II to deal with this matter, all unsuccessful. My point here is to encourage the Congress and the new administration to launch together a serious study of how to deal with the shortcomings of a system which has simply outlived its rationale and its usefulness. That indeed is a project worthy of a new administration, interested not only in tweaking of oversight and regulatory procedures, but rather in simplifying an archaic, unduly complicated regulatory system, a structure that is itself acting as an impediment to efficient and stable markets. So given the nature of this occasion, Bretton Woods and all those two words evoke in terms of a grand vision of international cooperation and stable monetary systems, matters of financial regulation may seem prosaic. But I hope we've learned the lesson that financial distress can no longer be localized, that markets are inextricably interlinked. In the event of a future big crisis, there is no possibility of an international bailout of a failing American financial system. So we better work to keep it strong. Thank you very much.
So why don't you take a seat? Great job. Thank you, Paul. I think that you've given us a tour de force on the present status of the U.S. regulatory system and scene and its links internationally. I have a couple of questions for you before we open it up to the audience. One is your mention of the need for regulators globally to stay committed to a shared reform program. Does the rhetoric coming from some in the U.S. administration, including the White House, concern you in terms of their willingness to continue working internationally as we've seen over the last few years?
Yeah, well, I'm not sure this new administration fully has a program and approach worked out, and they seem to be saying different things at different times, but I do think there is some danger of short-sightedness in thinking that we can credibly and durably develop a financial system and financial regulations that are insulated from what other countries are doing. Now, I could say the same thing about other countries. I hope they're not proceeding in a way that is incompatible with what's reasonable for us. But a lot of progress has been made in this area, most importantly, most obviously in the capital requirements area. But not only that, but we could never have gotten this agreement in capital requirements and gotten a substantial increase in capital requirements without bringing along the rest of the world in that direction, because there would just be too many competitive dislocations if you didn't have some consistency internationally. But it's true in many other areas, or in all other areas almost.
One of the other points I wanted to ask you to pick up on what you said is that one of the areas you've spoken about frequently, and you mentioned it in your speech, is a multi-agency regulatory structure here in the U.S. Do you believe that the Obama administration, where you played a role for a while, missed an opportunity to reform here and simplification? Not only reform, but end simplification in this area.
I think basically what happened was the administration and the Congress in particular were preoccupied with what was necessary to deal with the weaknesses in the system at the time, which capital was one, but many other questions arose. And both Mr. Frank's mind and more specifically in Senator Dodd's mind was the idea that they would do something about the number of institutions involved. But when they looked at making legislation, you know, was tough enough to get the regulation without burdening it with all the arguments about institutional change. But now, when the regulation and supervision and so forth are more or less settled, I hope, I think it'd be an appropriate time to come back, because the shortcomings of the present system are so evident. I shouldn't tell stories. I'll tell a story. It's not a story. If you read the official investigation of the financial crisis, they have a lovely interview with Janet Yellen. She was then president of the Federal Reserve Bank of California, where a lot of this excessive mortgage lending was taking place. And they said, we congratulate you, Mrs. Yellen. You called attention to the excesses of the mortgage market back in whatever it was, in 2004, 5, 6. She said, we congratulate you. She said, thank you very much. He said, Mrs. Yellen, why didn't you do something about it? And her response was a perfect reflection of the difficulties in the system. She said, well, I did take it up in Washington, but they didn't seem to be terribly interested. And it was not in my purview as the president of a Federal Reserve Bank. We don't have any regulatory authorities, so I had no direct responsibility for this. And, you know, when they passed Glass-Steagall, they left the broker-dealer under the control of the SEC, not the Federal Reserve. And the instruction was, Federal Reserve, you may have oversight over the whole holding company, but you better pay attention to what the other regulators think about specific parts, including what the other regulators thought about the broker-dealer, where all this is taking place. The regulator in charge of the broker-dealer had no interest in this subject, I'll tell you. And so what happened? A perfect example of a regulatory lapse.
Paul, you always get to the very heart of the matter. As so many of us in the room know, who observed that crisis and also dealt with you on so many issues when you were chairman of the Fed, particularly the Latin American debt crisis. One last question here, which is something you didn't cover before I open it to the floor. You did not mention in the speech consumer protection, which is a big area, in particular the Consumer Financial Protection Bureau. What are your views on this agency? As you know, it's highly controversial, and it should exist. And what do you think the future should be of this agency?
Well, actually, it's an interesting example, because that is one place where they did make some structural changes in the law, and they brought, Federal Reserve had some authority, SEC had some authority. They brought it all into this agency and gave it a pretty powerful mandate. And my impression is they've done geez, I thought the Federal Reserve did a good job on the little piece that we had when I was chairman. But it was a little piece of the whole. My impression is they brought these regulatory and supervisory concerns together in a more comprehensive and fairly simplified way, partly because there was only one agency involved. Now the question that arises, is it really appropriate to have a one-man agency appointed that can't be dismissed by the president? Perfectly reasonable question too. Okay, if you want to change that, I'm all with you, but how are you going to change it? We said in my little Volcker Alliance, we had comments about this. The fashion is, and I don't know what else to do, you set up a multi-person board, and it's got to be bipartisan, and it's 3-2 or 2-1 or whatever it is. Unhappily, well, that system worked pretty well. It's in this polarized world in which we live now, it's become politicized. So maybe we ought to set up a board, but I guess our suggestion was make the terms long enough so that there's some continuity, and it should be multi-partisan for sure. But you make the terms long enough, not as long as the Federal Reserve, but more than 4 or 5 years, maybe you will take some of the sting out of the politicization. I do think it's important, which is done under the present law in an odd kind of way, that it has independence in financial support.
Well, I certainly hope the White House is listening to your views on this, and the Secretary of the Treasury and others who are going to be making policy in this new administration in this particular area. I want to open it for questions. I had one question was mentioned to me earlier, and so I'd like to, and we'd like to have hands up here, but I had one question beforehand, and I'm looking at this person to raise her hand. Yes, so.
I know her, she's illegal.
Yeah, that's right. Former Federal Reserve employee.
Right, that's right. He used to be my boss one
So
day.
why don't you get up and say who you are?
Well, you got to hold his things for me. Okay. Nancy Jacklin. Used to work for Paul, used to also work for John Taylor, so I've got a lot of ex-bosses in here. You talked today about the importance of preserving a lot of the key elements of Dodd-Frank and not forgetting what took us to that point. The Volcker Alliance at the end of last year had issued a report about sort of the unfinished agenda in reforming the system, and you talked about the risks of short-term funding and runnable short-term funding and what that does to create financial crises. One thing that you hadn't mentioned in that report specifically is the contribution of our derivatives markets to systemic risk. And one particular aspect of them that seemed to me to fit into the Volcker rule type of issue is that the derivatives markets are now many times larger than the related cash markets and the reference assets, which suggests they're not being used for hedging. There's a lot of position taking in those markets. The question is whether that's a healthy and good and stable thing, or whether it is something that's contributing to the interconnections and the possible contagion in a way that may not be fully beneficial.
You've asked a question I'm sure I will not answer satisfactorily. Derivatives, at least the derivatives you're talking about, didn't exist for the first 70 years of my life. I've been able to fully accommodate myself to them. I think they are, when you see the volume of derivatives outstanding relative to the credits that they're supposed to be protecting against, there is clearly an imbalance. They act as an insurance policy, but you ordinarily don't have trading and insurance policies, and many insurance policies in the same risk. So I think there are some problems there, but progress has been made, and in the report you suggested, we did make some further suggestions, particularly in pushing as many of those derivatives as possible through an organized clearing house where you get much better protection, conceptually, if it's run right, against risk when the crisis comes, or the crisis won't come, because the obligations are better protected. that gives rise to the next question, which we did discuss in that report. What happens if something happens to the clearinghouse? And there does need to be some work in making sure that the clearinghouse themselves are protected by adequate capital and by support in other ways. That doesn't dismiss the possibility of maybe a lot of excessive trading in derivatives, but a lot more of it's been forced through the clearinghouses rather than so-called bespoke derivatives, which are probably more dangerous. So it's not an area where I claim any particular expertise, but I feel somewhat more comfortable than I did in 2008.
Work in progress, I guess, Paul. And Nancy? Yes. Please
Good
just
afternoon.
identify yourself, okay?
I'm Paul Applegarth. Two quick questions. One, what are your views on the fiduciary rule, the proposed fiduciary rule?
Yes.
And then secondly, regarding the future of the mortgage market, how do you see the future roles of Fannie Mae and Freddie Mac?
On the fiduciary rule, I am sympathetic to it. I'm not a great expert, but it sounds right, and I think it is right. It's hard to object to it, frankly. Now, the argument is that some poor people can't afford to get good advice, but I'm sympathetic with it. The other part,
Mortgage.
mortgage.
Fannie Mae, Freddie Mac.
That is clearly unfinished business. I mean, here we had the mortgage market was the heart of the crisis. Fannie Mae and Freddie Mac were, the word that comes to mind, bastard institutions, and I'm not sure that's a quite right word, but they were neither fish nor fowl, and the fishiness became apparent in the midst of the crisis. And one thing you could say after the crisis, let's not do that again. But we have not come to some consensus. We worried about this when I was back on this presidential advisory board. And point number one was don't repeat the mistake of Fannie and Freddie and hermaphrodite institutions. But it's very convenient to have it. And why is it as convenient as it is? The United States has a fixation on 30-year fixed-rate mortgages with no prepayment penalties, which are a lovely document for the borrower, but they're not such a lovely document for the lender, and particularly for institutional lenders like banks or in the old days savings and loans. So you wiped out a natural reserve of potential mortgage lending. And you'd like to see some movement toward more use of other than 30-year fixed-rate mortgages. So long as they exist, I think they're going to be securitized, at least in large part. And so we have to develop a system, which I think they're kind of doing by fits and starts, that will be safer than the old system, and you will have a lot of securitization. But securitization, I hope, protected by the private sector rather than the public sector.
Paul, do you think, just to follow up on that, do you think that this administration really should tackle what's going to happen with Fannie Mae and Freddie Mac? because it's like kicking the can down the road?
There's been a lot of kicking down the road. Yes, they should. I mean, we ought to reform the mortgage market, but we're having difficulty doing it. And a major source of the difficulty is the inbred political convenience of these 30-year fixed-rate mortgages, which you need to develop a market structure in which they're viable and safe. And by fits and starts, I think we're doing that, but I would hope there could be more initiative in what most other countries have. You have maybe fixed for 5 years or something, and then there can be a refixing, and there's cost you a little bit if you have to get out beforehand. But you're dealing with pretty deep-seated political questions when you begin fussing around with the accessibility of mortgages, particularly small mortgages.
Right. John, you had your hand up? John Taylor, over here, microphone.
There's a bill that's passed the House Judiciary Committee unanimously. It's passed the House by a voice vote, it's pretty nonpartisan, bipartisan, to reform the bankruptcy code for financial institutions. It's called the Financial Institution Bankruptcy Act. It would sit on top of Title II of Dodd-Frank. You have any thoughts about that?
Well, from what I may not understand it fully, but to the extent that that is an attack on the resolution authority, I think it's a big mistake. I don't think you can solve this through the ordinary bankruptcy. Some maybe there are a few that come along that you can. But I frankly don't understand what the complaint is. I think it's kind of, well, it's ideological or something. But there's a feeling that, I don't know, the FDIC can't handle this as well as a bankruptcy court. Bankruptcy court handling the failure of overnight, over a weekend, of Lehman or Citibank or anything, you know, it's just not with us. You've got to have some, it's got the peculiarity, you have to deal with these things in a hurry. You have to deal with them in a way that doesn't screw up the whole market. And the market, in those circumstances, is going to be very sensitive. And, you know, if the language can be tweaked to something, I don't know, but I certainly...
Actually, just a point of information, it doesn't repeal.
Yeah, the microphone, because John, I can't hear you in the back.
It's not an alternative. It's on top. It's another approach. It doesn't repeal Dodd-Frank. It's Dodd-Frank stays.
Yeah, well, as I understand, it's an effort to put something in there before Dodd-Frank. And I don't know why. I mean, I do not understand why this approach is proposed. I don't understand it. Why? Is it because you don't trust the FDIC, or you don't, you're willing to take the risk? And I'm sure it's not because you want to take the risk and screwing up the market. I just plead ignorance. I do not understand why this is important. I mean, I know you can explain to me why you think it's important.
We're going to have you next year, John, talk about that. We haven't had any questions from over here. Yes, we have one right here.
Hi, Bill Salter from Citigroup. Recently, Neil Kashkari responded to Jamie Dimon's letter suggesting that too big to fail had not been solved and that higher capital levels might achieve it. Question one, do you think too big to fail, that we are in a reasonable position now, given the years that we've had to implement it? And two, do you think higher capital levels, or is there something we have to do about liquidity or some other solution?
Well, let me say, I think it's, the substance of my remarks, it may have suggested that we are in a much better position to fend off failing banks, which is the object. We don't have failing banks, we don't have to worry about too big to fail, because they're not going to fail. And that's what a lot of the controls and capital requirements are directed toward. The resolution process is just it's a safety valve that, for all the increase in capital requirements or liquidity requirements or all the other supervision that's been introduced, if it fails, do you need this final backstop? I hope not in my lifetime. But I even hope not in your lifetime. In my lifetime isn't long enough to answer this problem. But this is just talking, it's a real, last resort, but I don't want to be without the last resort if you need it.
Okay, one more question. We could go on all night here, but we got to get Paul back on a train. He has television interview, so please identify yourself.
My name is Nathaniel Welch. My question is, under the Trump presidency, I was curious what you think implications of a conservative majority board at the Fed might have on short and long-term, national and international economics. Thanks.
It's always the last one that gets you, Paul.
The Fed, ever uberalis, the Federal Reserve shall triumph and continue and be strong. And I hope Mr. Trump and his associates realize the importance of first-class appointments to the Federal Reserve. The Federal Reserve, I must say, I made a comment about the politicization of a lot of these regulatory agencies. And they weren't designed to be politicized, presumably, but it's in the air in Washington. I think the Federal Reserve has been exempt from that. I have had no sense in any serious way that people on the Federal Reserve Board take positions either on policy or in regulation that is kind of stimulated by political considerations.
Well, I think from Paul, I said it was a tour de force, and I think particularly with the new administration, with a lot of new ideas coming in, changes in the board of the Federal Reserve, what's going on in international regulation, I think Paul's speech was a speech for the moment and a guidance for the future and very meaningful. And Paul, thank you very much for that. But also, before we close the meeting, I have to say that this country owes so much to Paul Volcker, and so does the international system. And we're very lucky that
Bill
he
Rhodes
did
was
what he
always
did.
there to save us.
So,
And the great thing about finishing with Paul Volcker is that when he wants to speak and share a story or perhaps a warning or two, we all stay and we all listen. So thank you very much, Paul.
there you go, Paul.
And as we close out today, I'd like to say again, thank you very much to the IMF for supporting us with a venue, to our sponsor, SICPA, to our staff, Bretton Woods committee team, to our audience for great questions, very thoughtful questions as usual, as expected. And most of all, to all of our speakers and moderators for today's event. Thank you very much. Reception outside, and this meeting is adjourned.